Question 1. When evaluating a client's request to invest in a specific, potentially high-risk product they have heard about, what is the most appropriate course of action for an investment advisor registered in Ontario, Canada, to ensure compliance with regulatory requirements and ethical obligations? Option A. Recommend the investment based on the client's expressed interest, assuming that their desire to invest in it indicates a sufficient understanding of its risks. Option B. Proceed with the investment as requested by the client, as their explicit instruction overrides the need for a detailed suitability assessment. Option C. Inform the client that the requested investment is not suitable and refuse to discuss it further, without exploring the client's underlying motivations or offering alternatives. Option D. Conduct a comprehensive suitability assessment to understand the client's financial situation, investment objectives, risk tolerance, and time horizon, and then recommend investments that align with this assessment, explaining why the client's initial request may or may not be suitable. Correct answer is D. Conduct a comprehensive suitability assessment to understand the client's financial situation, investment objectives, risk tolerance, and time horizon, and then recommend investments that align with this assessment, explaining why the client's initial request may or may not be suitable. Explanation. This scenario presents a professional challenge because it requires balancing the client's immediate desire for a specific investment strategy with the advisor's fiduciary duty to ensure that strategy is suitable and compliant with Ontario's securities regulations. The advisor must navigate potential conflicts of interest and avoid making recommendations that could be perceived as self-serving or detrimental to the client's best interests, even if the client expresses a strong preference. The best approach involves a thorough suitability assessment that goes beyond the client's stated preference. This includes understanding the client's financial situation, investment objectives, risk tolerance, and time horizon, as mandated by Ontario Securities Commission OSC. Rule 31-505, Registration Requirements, Conduct of Business and Reporting, and the client-focused reforms that emphasize a client's best interest. The advisor must then recommend investments that align with this comprehensive assessment, even if it means explaining why the client's initial idea might not be appropriate. This ensures compliance with regulatory obligations to act honestly, in good faith, and with a view to the best interests of the client. Recommending the investment solely based on the client's stated preference without a proper suitability assessment is a significant regulatory and ethical failure. It breaches the duty to act in the client's best interest and could lead to unsuitable investments, exposing the client to undue risk and potentially violating OSC regulations. Another incorrect approach is to dismiss the client's preference outright, without understanding the underlying reasons. While the advisor has a duty to ensure suitability, a complete disregard for the client's input can damage the client relationship and may overlook valid, albeit perhaps unarticulated, client concerns or objectives. This approach fails to engage in a collaborative process that is essential for building trust and achieving client satisfaction within regulatory boundaries. Finally, recommending an investment that is complex or potentially unsuitable simply because the client has heard about it and expressed interest, without adequate due diligence and explanation of risks, is also professionally unacceptable. This approach prioritizes client appeasement over responsible advice and can lead to regulatory scrutiny and client harm. Professionals should adopt a decision-making process that begins with understanding the client's stated needs and preferences, but then rigorously applies a suitability framework. This involves gathering comprehensive client information, analyzing that information against regulatory requirements and ethical standards, recommending suitable options with clear explanations of risks and benefits, and documenting the entire process. If a client's preference conflicts with suitability, the professional must clearly explain the discrepancies and guide the client towards appropriate alternatives. Question 2. The analysis reveals that a financial advisor in Ontario, Canada, has a long-standing client who has expressed a general interest in investments offering higher growth potential. The advisor is considering recommending a new, complex investment product that has recently become available. This product is characterized by its innovative structure, which carries a higher degree of risk and potential volatility compared to traditional investments, though it also offers the possibility of significant returns. The client has a moderate risk tolerance and a stable financial situation, but has limited experience with complex financial instruments, considering the regulatory framework of the Ontario Securities Commission (OSC), which approach should the advisor adopt when considering this recommendation? Option A. Present the new product to the client, highlighting its potential for high returns while briefly mentioning that it involves some risk, without delving into the specific complexities. Option B. Conduct a detailed suitability assessment that specifically evaluates the client's risk tolerance, financial objectives, and investment knowledge against the unique risks and potential returns of the new product, ensuring all material risks are clearly disclosed. Option C. Recommend the product as a sure thing for significant growth, given the client's desire for higher potential returns and the product's innovative nature. Option D. Proceed with the recommendation based on the client's general interest in growth, assuming their moderate risk tolerance is sufficient for this new product. The correct answer is B. Conduct a detailed suitability assessment that specifically evaluates the client's risk tolerance, financial objectives, and investment knowledge against the unique risks and potential returns of the new product, ensuring all material risks are clearly disclosed. Explanation. The analysis reveals a scenario where a financial advisor in Ontario, Canada, must navigate the complex requirements of the Ontario Securities Commission (OSC) regarding client suitability and disclosure when recommending a new investment product. The challenge lies in balancing the client's stated risk tolerance and financial goals with the specific characteristics of a novel, potentially high-risk product, while ensuring full and transparent disclosure as mandated by OSC Rule 31-505. The best professional practice involves a thorough, documented assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge of investments, directly comparing these against the specific features, risks, and potential rewards of the proposed product. This approach ensures compliance with OSC Rule 31-505, which mandates that registrants must have reasonable grounds to believe that a recommendation is suitable for a client, considering their investment profile. It also aligns with the ethical obligation to act in the client's best interest, requiring a deep understanding of both the client and the product before making a recommendation. Recommending the product without a detailed suitability assessment, based solely on the client's general interest in growth, fails to meet the regulatory standard. This approach ignores the specific risk profile of the new product and the client's capacity to absorb potential losses, violating the suitability requirement under OSC Rule 31-505. Suggesting the product while downplaying its unique risks, even if the client expresses enthusiasm, is also professionally unacceptable. This constitutes a failure in disclosure, a core tenet of OSC regulations, and misrepresents the investment's true nature, potentially leading the client to make an uninformed decision and breaching the duty of care. Presenting the product as a guaranteed high-return opportunity without adequate risk disclosure is a severe regulatory and ethical breach. This is misleading and directly contravenes the OSC's expectations for fair and balanced presentations of investment opportunities, failing to uphold the client's right to accurate information. Professionals should adopt a structured decision-making process. 1. Understand the client. Conduct a comprehensive and documented Know Your Client KIC process, including risk tolerance, financial situation, investment objectives, and investment knowledge. 2. Understand the product. Thoroughly research and understand the features, risks, potential returns, liquidity, and costs associated with any proposed investment. 3. Comparative analysis. Directly compare the client's profile with the product's characteristics to determine suitability. 4. Disclosure. Provide clear, concise, and complete disclosure of all material risks and benefits. 5. Documentation. Maintain detailed records of all client interactions, assessments, recommendations, and disclosures. 6. Seek clarification. If there is any doubt about suitability or disclosure, seek guidance from compliance or senior management. Question 3. The risk matrix shows a hypothetical down driver's test designed to illustrate potential portfolio impacts during severe market contractions. Considering the regulatory framework of Ontario, Canada, which approach best ensures compliance and client understanding when discussing this test with clients? Option A. Market the down driver's test as a proprietary analytical method that helps identify investments likely to underperform in adverse market conditions. Option B. Advise clients that the down driver's test is a definitive indicator of future market movements and that their portfolios should be adjusted accordingly based on its outcomes. Option C. Use the down drivers test in client presentations without any specific disclaimers, assuming clients will understand its hypothetical nature. Option D. Present the down drivers test as an educational tool to illustrate potential risks and the importance of diversification, clearly stating it is a hypothetical scenario and not a prediction of future performance. The correct answer is D. Present the down drivers test as an educational tool to illustrate potential risks and the importance of diversification, clearly stating it is a hypothetical scenario and not a prediction of future performance. Explanation. This scenario presents a professional challenge because it requires balancing the need to provide accurate and timely information to clients with the regulatory obligation to ensure that all communications are fair, clear, and not misleading. The firm's internal policies and the regulatory framework of Ontario, Canada, specifically the Ontario Securities Commission, OSC, rules, mandate that investment advice must be suitable for the client and that promotional materials must not create unrealistic expectations. The challenge lies in interpreting the down drivers test concept in a way that is both informative and compliant. Best professional approach involves clearly defining the down drivers test as a hypothetical scenario used for educational purposes to illustrate potential market downturns and their impact on investment portfolios. This approach emphasizes that it is not a predictive tool, but a risk management illustration. It requires the firm to explicitly state that the test is a simulation, not a forecast, and that past performance is not indicative of future results. This aligns with OSC Rule 31-505, which requires registrants to provide fair and balanced information and to avoid making misleading statements. By framing it as an educational tool, the firm can discuss potential risks without implying certainty or guaranteeing outcomes, thereby fulfilling its duty of care and regulatory obligations. An incorrect approach would be to present the down drivers test as a definitive method for predicting future market performance or as a guarantee of how specific investments will behave. This would be misleading and could create unrealistic expectations for clients, violating the OSC's requirements for fair and balanced communication. Such an approach fails to adequately disclose the speculative nature of market predictions and the inherent uncertainties in investment. Another incorrect approach would be to use the down drivers test in marketing materials without any disclaimers or context, implying that it is a standard or reliable analytical tool. This would be a direct contravention of the OSC's rules against misleading advertising and the requirement to provide sufficient information for clients to make informed decisions. The absence of context and disclaimers would lead clients to believe the test has predictive power it does not possess. Finally, an incorrect approach would be to dismiss the down drivers test entirely without considering its potential educational value. While it may be a hypothetical concept, understanding how hypothetical adverse scenarios might impact investments is a legitimate part of financial education and risk management. A complete refusal to engage with the concept without offering a compliant alternative for discussing risk misses an opportunity to educate clients and could be perceived as unhelpful. Professionals should adopt a decision-making process that prioritizes regulatory compliance and client best interests. This involves 1. Understanding the regulatory requirements of the jurisdiction, Ontario Securities Commission rules. 2. Analyzing the proposed communication or concept for potential misinterpretations or misleading implications. 3. Developing a strategy that educates clients about risks and market dynamics in a fair, clear, and balanced manner, using appropriate disclaimers and context. 4. Consulting with compliance departments when in doubt about the appropriateness of any communication. Question 4. Implementation of a client's investment preference in Ontario, which appears to carry higher risks than initially assessed for their profile, requires careful consideration. An investment advisor in Ontario has a client who insists on investing in a particular high-volatility sector, despite the advisor's assessment that this deviates from the client's stated risk tolerance and financial objectives. What is the most appropriate course of action for the advisor to ensure compliance with Ontario securities regulations and professional ethics? Option A. Clearly explain the heightened risks and potential downsides of the client's preferred investment. Document this discussion thoroughly, and proceed with the investment only after obtaining the client's explicit, informed consent, ensuring the client understands the implications. Option B. Proceed with the client's preferred investment without further discussion, relying on a general disclaimer signed at the outset of the relationship to cover potential negative outcomes. Option C. Immediately terminate the advisory relationship if the client insists on proceeding with the high-risk investment, citing irreconcilable differences in investment philosophy. Option D. Firmly advise the client that the preferred investment is unsuitable and unilaterally implement a more conservative investment strategy that aligns with the advisor's assessment of the client's risk profile. The correct answer is A. Clearly explain the heightened risks and potential downsides of the client's preferred investment, document this discussion thoroughly, and proceed with the investment only after obtaining the client's explicit, informed consent, ensuring the client understands the implications. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the advisor's fiduciary duty to act in the client's best interest, particularly when the client's preference may lead to suboptimal outcomes or increased risk. The advisor must navigate this by prioritizing regulatory compliance and ethical obligations over simply acceding to client demands. Careful judgment is required to balance client autonomy with the advisor's responsibility to provide sound, compliant advice. Correct approach analysis. The best professional practice involves clearly explaining to the client the risks and potential downsides of their preferred investment strategy, referencing the specific disclosure requirements under Ontario securities law. This approach prioritizes transparency and client education, ensuring the client understands the implications of their choices. It aligns with the regulatory obligation to act honestly, in good faith, and to deal fairly with clients, as mandated by the Ontario Securities Commission OSC Rules of Professional Conduct. By documenting this discussion and the client's informed decision, the advisor fulfills their duty of care and demonstrates compliance with suitability requirements. Incorrect approaches analysis. One incorrect approach involves proceeding with the client's preferred investment without adequately explaining the associated risks or documenting the discussion. This fails to meet the regulatory requirement for suitability and the ethical obligation to ensure clients understand the products they are investing in. It could be construed as a breach of the duty to act honestly and in good faith, potentially exposing the advisor to regulatory sanctions and client complaints. Another incorrect approach is to dismiss the client's preference outright and unilaterally impose a different investment strategy. While the advisor may believe this is in the client's best interest, it disregards the client's autonomy and the importance of client consent. This can lead to a breakdown in the client relationship and may not fully satisfy the requirement for a client-driven, albeit informed, decision-making process. It also risks failing to adequately document the client's rationale for their initial preference, which could be relevant in future reviews. A further incorrect approach is to solely rely on a pre-signed disclaimer that attempts to absolve the advisor of responsibility. Such disclaimers are often insufficient to override regulatory obligations, especially if the advisor has not taken reasonable steps to ensure the client's understanding and the suitability of the investment. Ontario securities law emphasizes the advisor's ongoing responsibility to act in the client's best interest, and a blanket disclaimer does not negate this duty. Professional reasoning. Professionals should adopt a client-centric yet compliant approach. This involves actively listening to client preferences, thoroughly assessing their suitability based on regulatory requirements, e.g., risk tolerance, financial goals, knowledge, and engaging in transparent, documented discussions about potential outcomes and alternatives. When a client's preference diverges from a recommended course of action, the professional's duty is to educate, explain, and obtain informed consent, rather than simply agreeing or disagreeing. The decision-making process should be guided by the principles of honesty, integrity, fairness, and the paramount importance of client best interests, as enshrined in provincial securities regulations. Question 5. To address the challenge of a client in Ontario who explicitly states a desire for extremely aggressive growth and high-risk investments, what is the most appropriate course of action for an investment advisor regulated by the Ontario Securities Commission OSC? Option A. Focus exclusively on the potential for high returns when presenting investment options, downplaying the associated risks to satisfy the client's aggressive growth objective. Option B. Delay the detailed suitability assessment until after the initial aggressive investments have been made to avoid potentially discouraging the client. Option C. Conduct a comprehensive suitability assessment, documenting the client's financial situation, investment objectives, and risk tolerance, and then recommend investments that align with this assessment, even if they are less aggressive than initially requested, while clearly explaining the rationale and risks to the client. Option D. Immediately proceed with investing the client's funds in a portfolio heavily weighted towards highly speculative assets, as per the client's stated desire for aggressive growth. The correct answer is C. Conduct a comprehensive suitability assessment, documenting the client's financial situation, investment objectives, and risk tolerance, and then recommend investments that align with this assessment, even if they are less aggressive than initially requested, while clearly explaining the rationale and risks to the client. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires an investment advisor to balance a client's stated desire for aggressive growth with the advisor's fiduciary duty to ensure investments are suitable and align with the client's actual risk tolerance and financial capacity. Misjudging this balance can lead to significant financial harm for the client and regulatory repercussions for the advisor. The advisor must navigate potential conflicts between client wishes and regulatory obligations, particularly under the Ontario Securities Commission (OSC) framework. Correct approach analysis. The best professional practice involves a thorough and documented assessment of the client's financial situation, investment objectives, and risk tolerance, even when the client expresses a strong preference for aggressive growth. This approach, which prioritizes a comprehensive understanding of the client's needs and regulatory requirements, is correct because it directly aligns with the OSC's client-focused regulations, such as those emphasizing suitability and Know Your Client (KIC) principles. By conducting a detailed suitability assessment, the advisor fulfills their fiduciary duty to act in the client's best interest, ensuring that any recommended investments, even aggressive ones, are appropriate given the client's overall financial picture and capacity to absorb potential losses. This documented process provides a robust defense against potential claims of unsuitability. Correct approach is analysis, recommending a portfolio heavily weighted towards highly speculative assets solely based on the client's verbal assertion of wanting aggressive growth, without a thorough suitability assessment, is professionally unacceptable. This approach fails to meet the OSC's KYC and suitability obligations, as it prioritizes a client's expressed desire over a comprehensive understanding of their actual financial capacity and risk tolerance. It exposes the client to undue risk and the advisor to regulatory sanctions. Similarly, delaying the detailed suitability assessment until after the initial aggressive investments are made is also unacceptable. This backward approach fundamentally undermines the suitability requirement, as it means investments are being made without a proper foundation of client understanding. It suggests a reactive rather than proactive approach to client protection and regulatory compliance. Finally, focusing solely on the potential for high returns without adequately discussing the associated risks and the client's ability to withstand potential losses is a failure to provide complete and balanced advice, which is a cornerstone of ethical and regulatory practice under the OSC. Professional reasoning. Professionals should adopt a structured decision-making process that begins with a comprehensive client discovery phase. This involves actively listening to the client's stated goals, but critically evaluating them against objective financial data and risk assessment tools. The advisor must then document this assessment thoroughly, ensuring that any recommendations are demonstrably suitable and aligned with regulatory requirements. When there is a divergence between a client's expressed desires and what appears suitable, the professional must engage in a clear and documented discussion with the client, explaining the rationale behind their recommendations and the potential consequences of different investment strategies. This process ensures both client understanding and regulatory compliance. Question 6. Examination of the data shows that a client in Ontario has expressed a strong desire to invest a significant portion of their liquid assets into a highly speculative, illiquid private equity fund that is not readily available on public exchanges. The client is aware of the risks but insists on proceeding, stating they have a gut feeling about the investment's potential. As a registered investment advisor in Ontario, how should you best proceed? Option A. Engage in a detailed discussion with the client to understand their motivations, explain the specific risks and regulatory considerations of such an investment under Ontario securities law, and assess its suitability against their stated financial goals and risk tolerance. Option B. Proceed with the investment as requested by the client to maintain a positive client relationship and avoid conflict, assuming the client is an informed adult capable of making their own decisions. Option C. Advise the client that you cannot facilitate this investment and suggest they seek advice from a different advisor who may be more willing to accommodate their request. Option D. Immediately execute the investment transaction to fulfill the client's explicit instructions, as their directive overrides any concerns about suitability or regulatory compliance. The correct answer is A. Engage in a detailed discussion with the client to understand their motivations. Explain the specific risks and regulatory considerations of such an investment under Ontario securities law, and assess its suitability against their stated financial goals and risk tolerance. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the potential for their actions to cause harm or violate regulatory requirements. The advisor must navigate this delicate situation by balancing client autonomy with their fiduciary duty and adherence to provincial securities regulations in Ontario. The pressure to maintain a client relationship can be significant, but it must not override the obligation to act in the client's best interest and within the bounds of the law. Correct approach analysis. The best professional practice involves a direct, yet empathetic conversation with the client to understand the underlying reasons for their request and to educate them on the regulatory implications and risks associated with their proposed investment strategy. This approach aligns with the Ontario Securities Commission (OSC) Rule 31-505 regarding suitability, and the advisor's obligation to ensure that any recommended investment is appropriate for the client's financial situation, investment objectives, and risk tolerance. By seeking to understand the client's motivations and explaining the regulatory framework, the advisor upholds their duty of care and acts in the client's best interest, even if it means advising against a specific transaction. Incorrect approaches analysis. Proceeding with the investment without further discussion or clarification would be a significant regulatory failure, would violate the advisor's duty to assess suitability, and could expose both the client and the advisor to undue risk and potential regulatory sanctions from the OSC. Agreeing to the investment solely to appease the client, without addressing the suitability concerns or regulatory implications, demonstrates a failure to act in the client's best interest and a disregard for professional obligations. Suggesting the client seek advice from another advisor without first attempting to resolve the situation internally could be seen as an abdication of responsibility, especially if the advisor believes they can still guide the client towards a suitable outcome within the regulatory framework. Professional reasoning. Professionals should adopt a framework that prioritizes understanding the client's needs and objectives, followed by a thorough assessment of suitability and regulatory compliance. When a client's request appears to conflict with these principles, the professional's first step should be open communication to explore the rationale behind the request and to provide clear, reasoned explanations of any potential issues. This process allows for informed decision-making that respects client autonomy while upholding professional and regulatory standards. Question 7. Research into investment advisory practices in Ontario reveals a client expressing a strong desire to invest a significant portion of their portfolio in a highly speculative, emerging market cryptocurrency, despite their stated objective of long-term capital preservation and a low-risk tolerance. As an advisor registered in Ontario, what is the most appropriate course of action to uphold your fiduciary duty and comply with Ontario Securities Commission (OSC) regulations? Option A. Conduct a detailed assessment of the client's overall financial situation, risk tolerance, and investment objectives, then clearly explain the potential risks and downsides of the cryptocurrency investment in relation to their stated goals, offering alternative, more suitable investment options that align with their risk profile and objectives. Option B. Immediately execute the client's requested investment in the cryptocurrency, as client instructions are paramount and must be followed without deviation. Option C. Politely decline to discuss cryptocurrency investments altogether, stating that such assets are outside the scope of your advisory services and suggesting the client seek advice from a specialist in that area. Option D. Proceed with the cryptocurrency investment, but assure the client that the risks are minimal and that this is a unique opportunity for significant gains, downplaying the speculative nature of the asset. The correct answer is A. Conduct a detailed assessment of the client's overall financial situation, risk tolerance, and investment objectives. Then clearly explain the potential risks and downsides of the cryptocurrency investment in relation to their stated goals, offering alternative, more suitable investment options that align with their risk profile and objectives. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated desire and the advisor's fiduciary duty to act in the client's best interest, particularly when the client's request may lead to suboptimal outcomes or increased risk. The advisor must navigate this by prioritizing regulatory compliance and ethical obligations over simply fulfilling a client's immediate, potentially ill-informed instruction. The challenge lies in educating the client and guiding them towards a decision that aligns with their long-term financial well-being and regulatory requirements, without alienating them. Correct approach analysis. The correct approach involves a thorough assessment of the client's financial situation, risk tolerance, and investment objectives, followed by a clear explanation of the implications of their request. This approach prioritizes the advisor's fiduciary duty under the Ontario Securities Commission (OSC) regulations, which mandates acting honestly, in good faith, and with a view to the best interests of the client. By explaining the potential downsides of the requested investment, such as increased volatility or misalignment with long-term goals, and offering suitable alternatives, the advisor upholds their regulatory obligations and ethical commitment to client welfare. This proactive and educational stance ensures the client makes an informed decision that is in their best interest. Incorrect approaches analysis. One incorrect approach involves immediately executing the client's request without further inquiry or explanation. This fails to meet the fiduciary duty under OSC regulations, as it prioritizes client instruction over the client's best interests and potentially exposes them to undue risk or suboptimal returns. Neglects the advisor's responsibility to provide informed guidance. Another incorrect approach is to dismiss the client's request outright without understanding their rationale or attempting to educate them. While the request may be ill-advised, a complete dismissal can damage the client relationship and may not address the underlying reasons for the client's interest, potentially leading them to seek advice elsewhere that may not be as scrupulous. This approach lacks the professional communication and client-centric focus required by OSC guidelines. A third incorrect approach is to proceed with the investment while downplaying the associated risks to the client. This is a direct violation of the duty to provide accurate and complete information. OSC regulations require full disclosure of material risks, and attempting to obscure or minimize these risks constitutes a breach of trust and regulatory requirements, potentially leading to significant client harm and regulatory sanctions. Professional reasoning. Professionals should adopt a client-centric, risk-aware, and regulatory-compliant decision-making process. This involves actively listening to the client's needs and desires, but critically evaluating them against their stated objectives and risk profile. The process should include a robust fact-finding stage, followed by clear, transparent communication about the implications of any proposed action, including potential risks and benefits. When a client's request appears to conflict with their best interests or regulatory requirements, the professional's duty is to educate, advise, and propose suitable alternatives, always documenting the rationale for their recommendations and the client's ultimate decisions. Question 8. Which approach would be most appropriate for a financial advisor in Ontario, Canada, when a long-standing client who has always been transparent suddenly deposits a large sum of cash from an unspecified source, raising potential concerns about money laundering? Option A. Immediately file a suspicious transaction report with FINTRAC, citing the large cash deposit as the sole reason. Option B. Discuss the client's unusual deposit with other financial advisors within the firm to gauge their opinions. Option C. Discreetly inquire with the client about the source of the funds, and if concerns remain, consult the firm's compliance department before considering any external reporting. Option D. Ignore the deposit and continue with normal client service, assuming the client's past transparency is sufficient. Correct answer is C. Discreetly inquire with the client about the source of the funds, and if concerns remain, consult the firm's compliance department before considering any external reporting. Explanation. Scenario analysis. This scenario presents a professional challenge because it requires a financial advisor in Ontario, Canada, to balance client confidentiality with the potential need to report suspicious activity that could indicate money laundering. The advisor must navigate the strict privacy obligations under Ontario's Personal Information Protection and Electronic Documents Act, PIPEDA, and the Federal Proceeds of Crime, Money Laundering, and Terrorist Financing Act, PCMLTFA, while also adhering to the reporting obligations under the PCMLTFA and FINTRAC guidelines. Failure to report could have severe legal and reputational consequences, while an unfounded report could damage the client relationship and violate privacy laws. Correct approach analysis. The best professional practice involves a multi-step approach that prioritizes gathering information internally to assess the situation before making any external reports. This begins with discreetly seeking clarification from the client about the source of funds, framing the inquiry within standard due diligence procedures. If the explanation is unsatisfactory or raises further red flags, the advisor should then consult their firm's internal compliance department. This internal consultation is crucial as it allows for a coordinated and informed decision-making process, ensuring adherence to both privacy regulations and anti-money laundering obligations. If, after internal review, reasonable grounds exist to suspect that the funds are proceeds of crime, the advisor, guided by compliance, would then proceed with filing a Suspicious Transaction Report, STR, with the Financial Transactions and Reports Analysis Centre of Canada, FINTRAC, as mandated by the PCMLTFA. This approach respects client privacy by attempting to resolve ambiguities internally first, while fulfilling legal reporting duties when necessary. Incorrect approach is analysis. Immediately reporting the client to FINTRAC without any internal inquiry or consultation would be a significant regulatory and ethical failure. This premature reporting violates the principle of proportionality and could constitute an unwarranted breach of client confidentiality under PIPEDA, potentially leading to legal repercussions and reputational damage. Furthermore, it bypasses the internal compliance framework designed to assess and manage such risks effectively. Another incorrect approach would be to ignore the red flags and take no action, citing client confidentiality. This directly contravenes the reporting obligations under the PCMLTFA and FINTRAC guidelines, exposing the advisor and their firm to severe penalties for non-compliance. This inaction constitutes a failure to uphold professional integrity and a disregard for the legal framework designed to combat financial crime. Finally, discussing the client's situation with colleagues outside of the compliance department without a clear need-to-know basis would also be an ethical breach, potentially violating PIPEDA and undermining client trust. Professional reasoning. Professionals in Ontario facing such situations should employ a structured decision-making process. First, they must understand the relevant regulatory landscape, including PIPEDA for privacy and the PCMLTFA and FINTRAC guidelines for anti-money laundering obligations. Second, they should always attempt to gather more information internally and discreetly, framing inquiries within standard client interaction protocols. Third, if suspicions persist, they must immediately escalate the matter to their firm's designated compliance officer or department for guidance and a formal assessment. This internal consultation is paramount before any external reporting is considered. Fourth, if the internal assessment confirms reasonable grounds for suspicion, the advisor must then follow the prescribed procedures for filing a suspicious transaction report with FINTRAC, ensuring all documentation is accurate and complete. This systematic approach ensures compliance, protects client interests where possible, and upholds professional responsibility. Question 9. The control framework reveals that a financial advisor in Ontario, Canada, has a client who is eager to invest in a highly speculative, unapproved product. The advisor believes this product is unsuitable given the client's moderate risk tolerance and limited investment experience, and it is not on the firm's approved list. Which of the following actions best aligns with the advisor's professional and regulatory obligations? Option A. Seek an exception from firm policy to allow the investment, without a comprehensive reassessment of the client's suitability for the product. Option B. Proceed with the investment as requested by the client, assuming the client understands the risks and is solely responsible for their decision. Option C. Inform the client that the product is not available through the firm and offer no further assistance or explanation. Option D. Conduct a thorough suitability assessment of the client for the proposed product. Explain to the client why it is not suitable based on their profile and firm policy, and explore alternative suitable investments. The correct answer is D. Conduct a thorough suitability assessment of the client for the proposed product. Explain to the client why it is not suitable based on their profile and firm policy, and explore alternative suitable investments. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, is presented with a client's desire to invest in a high-risk, speculative product that falls outside the firm's approved product list. This situation is professionally challenging because it pits the advisor's duty to act in the client's best interest and provide suitable advice against the firm's internal policies and risk management procedures. The advisor must navigate potential conflicts of interest, regulatory obligations under the Ontario Securities Commission, OSC, and the Investment Industry Regulatory Organization of Canada, IIROC, and the client's potentially uninformed risk tolerance. The best professional approach involves a thorough assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge of the proposed product, followed by a clear explanation of why the product is not suitable according to the firm's policies and regulatory requirements. This approach prioritizes the client's best interest by ensuring that any investment recommended is appropriate and aligns with regulatory standards for suitability. Specifically, under OSC Rule 31-505 and IIROC Dealer Member Rule 1300, advisors have a fundamental obligation to ensure that recommendations are suitable for their clients, considering all relevant personal circumstances. Recommending a product that is not on the firm's approved list, especially a speculative one, would likely violate these suitability obligations and the firm's internal compliance framework. An incorrect approach would be to proceed with the investment without adequate due diligence, simply because the client insists. This fails to uphold the advisor's fiduciary duty and regulatory obligations to protect the client from unsuitable investments. Another incorrect approach is to dismiss the client's request outright without a proper explanation or exploring alternative suitable options. This can damage the client relationship and may not fully address the client's underlying investment goals. Finally, attempting to circumvent firm policy by using a loophole or an unauthorized channel to facilitate the investment would be a serious breach of compliance and ethical conduct, exposing both the advisor and the firm to significant regulatory penalties. Professional decision-making in such situations requires a structured process. First, understand the client's request and underlying motivation. Second, consult firm policies and relevant regulations. Third, conduct a comprehensive suitability assessment. Fourth, communicate findings clearly and professionally to the client, explaining the rationale for any recommendations or rejections. And fifth, document all interactions and decisions thoroughly. Question 10. The control framework reveals that a financial advisor in Ontario, Canada, is evaluating a potential investment for a client. The investment is projected to generate cash inflows of $10,000 at the end of year 1, $12,000 at the end of year 2, and $15,000 at the end of year 3. The initial investment cost is $25,000. The client's required rate of return reflecting their risk tolerance and investment objectives as per OSC guidelines is 8% per annum. Assuming all cash flows occur at year-end, what is the net present value NPV of this investment? Option A, $12,000. Option B, $4,398.09. Option C, $7,000. Option D, $17,000. The correct answer is B, $4,398.09. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, must navigate the complexities of calculating the net present value, NPV, of a potential investment for a client, considering the Ontario Securities Commission OSC regulations regarding suitability and disclosure. The professional challenge lies in accurately applying financial mathematics while adhering to the OSC's stringent requirements for client-centric advice, ensuring all relevant costs and future cash flows are considered to present a true and fair view of the investment's potential. Miscalculations or omissions could lead to unsuitable recommendations and regulatory breaches. The best professional practice involves a meticulous calculation of the NPV, using the client's required rate of return as the discount rate, incorporating all projected cash inflows and outflows, and clearly disclosing the assumptions made. This approach aligns with OSC Rule 31-103 registration requirements, exemptions, and ongoing registrant obligations, which mandates that registrants must act in the best interest of the client and make suitable recommendations. By accurately discounting future cash flows to their present value, the advisor provides a quantitative basis for assessing the investment's profitability relative to the client's expectation, fulfilling the duty of care and disclosure. An incorrect approach would be to simply sum the projected future cash flows without discounting them. This fails to account for the time value of money, a fundamental principle in finance and a key consideration for suitability under OSC regulations. Such an approach would overstate the investment's potential return and could lead to a recommendation that is not in the client's best interest, violating the duty to provide suitable advice. Another incorrect approach would be to use a discount rate that is significantly higher than the client's required rate of return without proper justification. While a higher discount rate would reduce the NPV, using an arbitrary or excessively high rate to make an otherwise marginal investment appear unattractive could be seen as a form of misrepresentation or failure to act in the client's best interest, potentially contravening OSC disclosure obligations. A further incorrect approach would be to exclude certain anticipated costs or fees from the cash flow projections. This would artificially inflate the projected cash inflows and lead to an inaccurate NPV calculation. The OSC requires full and fair disclosure, and omitting material costs would be a direct violation of this principle, rendering the advice unsuitable. The professional reasoning process should involve 1. Understanding the client's financial goals and risk tolerance to determine an appropriate required rate of return. 2. Identifying all relevant cash inflows and outflows associated with the investment. 3. Applying the correct NPV formula using the client's required rate of return as the discount rate. 4. Performing sensitivity analysis to understand how changes in assumptions might affect the NPV. 5. Clearly documenting all calculations, assumptions, and the rationale for the recommendation, ensuring compliance with OSC disclosure and suitability requirements. Question 11. The control framework reveals that a financial advisor in Ontario, Canada, has a client who is eager to invest in a highly speculative and illiquid private equity fund that is not on the firm's approved product list. The client insists on proceeding, citing a tip from a friend. What is the most appropriate course of action for the advisor? Option A. Proceed with the investment as requested by the client, as their explicit instruction overrides the advisor's concerns about the product's suitability and the firm's approved list. Option B. Conduct a thorough suitability assessment, ensuring the client fully understands the significant risks, illiquidity, and potential for total loss, and if deemed suitable, follow the firm's procedures for considering non-approved products, or if unsuitable, explain why and propose alternative investments. Option C. Immediately reject the client's request, informing them that the product is not on the firm's approved list and therefore cannot be considered, without further discussion or exploration of alternatives. Option D. Advise the client to seek independent financial advice, and then proceed with the investment if the independent advisor approves, without further due diligence from the firm. The correct answer is B. Conduct a thorough suitability assessment, ensuring the client fully understands the significant risks, illiquidity, and potential for total loss, and if deemed suitable, follow the firm's procedures for considering non-approved products, or if unsuitable, explain why and propose alternative investments. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, is presented with a client's desire to invest in a high-risk, speculative product that is not typically offered by their firm. This situation is professionally challenging because it pits the advisor's duty to act in the client's best interest and to understand their client's risk tolerance against the firm's internal policies and the potential for significant client losses. The advisor must navigate regulatory requirements, firm procedures, and ethical obligations to ensure compliance and protect the client. The best professional approach involves a thorough due diligence process that prioritizes the client's understanding and suitability. This includes a detailed discussion with the client about the specific risks and potential downsides of the proposed investment, ensuring they fully comprehend the speculative nature and the possibility of losing their entire investment. The advisor must then assess whether this investment aligns with the client's stated financial goals, risk tolerance, and overall financial situation, as mandated by the Ontario Securities Commission (OSC), rules regarding suitability and know your client (KIC) obligations. If the investment is deemed unsuitable, the advisor must clearly explain this to the client and explore alternative, more appropriate investment options that meet their needs and risk profile. This approach upholds the advisor's fiduciary duty and regulatory obligations. An incorrect approach would be to proceed with the investment solely based on the client's request, without conducting a comprehensive suitability assessment. This fails to meet the OSC's requirements for understanding the client's financial situation and risk tolerance, potentially exposing the client to undue risk and violating the advisor's duty to act in their best interest. Another incorrect approach is to dismiss the client's request outright without a proper explanation or exploring alternatives. While the investment may be unsuitable, a professional advisor should engage in a constructive dialogue, explaining the rationale behind their concerns and offering suitable alternatives, rather than simply refusing to consider the client's wishes. Finally, attempting to circumvent firm policies by seeking an external approval without fully documenting the client's understanding and the rationale for considering such a product would also be professionally unacceptable, as it undermines internal controls and transparency. Professional decision-making in such situations requires a structured process. First, thoroughly understand the client's objectives and risk profile. Second, meticulously research the proposed investment, including its risks, rewards, and regulatory status. Third, assess the suitability of the investment against the client's profile and firm policies. Fourth, communicate findings clearly and transparently to the client, offering reasoned recommendations. And fifth, document all discussions and decisions meticulously. Question 12. The efficiency study reveals a significant disparity in the operational costs and client retention rates between two financial advisory branches in Ontario, Canada. One branch consistently outperforms the other. Which of the following is the most appropriate course of action for the firm's management to address this disparity? Option A. Assume the higher-performing branch is achieving its results through more aggressive sales tactics and recommend that the lower-performing branch adopt similar strategies to boost revenue, irrespective of client suitability. Option B. Focus solely on implementing cost-cutting measures at the underperforming branch to match the overheads of the higher-performing branch, without a comprehensive analysis of service quality or client impact. Option C. Propose tailoring service offerings and advice based on the perceived investment capacity of clients in each branch's demographic, potentially leading to differentiated service levels. Option D. Conduct a thorough internal review of operational processes, client service models, and client engagement strategies at both branches, focusing on identifying best practices and areas for improvement in a manner compliant with OSC regulations. The correct answer is D. Conduct a thorough internal review of operational processes, client service models, and client engagement strategies at both branches, focusing on identifying best practices and areas for improvement in a manner compliant with OSC regulations. Explanation. The efficiency study reveals a significant disparity in the operational costs of two branches of a financial advisory firm in Ontario, Canada. One branch consistently reports lower overheads and higher client retention rates than the other, despite serving a similar demographic. This scenario is professionally challenging because it requires a nuanced understanding of regulatory compliance and ethical conduct in financial advisory services, specifically within the framework of the Ontario Securities Commission (OSC) and relevant Canadian federal legislation. It necessitates identifying the root causes of the cost and retention differences without resorting to discriminatory or unethical practices. The best approach involves a comprehensive, data-driven internal review that focuses on operational efficiencies, service delivery models, and client engagement strategies. This approach prioritizes objective analysis of business practices, client feedback, and adherence to regulatory requirements such as those mandated by the OSC regarding fair dealing and client best interest. It seeks to identify best practices within the firm that can be replicated, rather than making assumptions about the underlying reasons for the disparity. This is correct because it aligns with the ethical obligation to treat all clients fairly and to operate the business in a manner that is compliant with securities laws, fostering a culture of continuous improvement and client centricity. An incorrect approach would be to assume that the lower-cost branch achieves its results through less rigorous client suitability assessments or by offering less comprehensive advice, thereby potentially compromising client best interests. This would be a regulatory failure under OSC rules, which mandate that advisors act in the best interests of their clients and conduct thorough suitability assessments. Another incorrect approach would be to attribute the difference to the client demographic served by each branch, and to suggest tailoring service levels based on perceived client wealth or investment capacity, which could lead to discriminatory practices and violate principles of fair dealing. Furthermore, an approach that focuses solely on cutting costs without considering the impact on service quality or regulatory compliance would be professionally unsound and could lead to breaches of fiduciary duties and regulatory obligations. Professionals should employ a decision-making framework that begins with a clear understanding of the regulatory landscape, OSC rules, Canadian securities legislation. This involves gathering objective data, analyzing operational processes, and seeking to understand client needs and satisfaction levels. Any proposed solutions must be evaluated against ethical principles and regulatory requirements, ensuring that client best interests are always paramount and that no discriminatory practices are employed. The focus should be on identifying and disseminating best practices that enhance both efficiency and client outcomes in a compliant manner. Question 13. The control framework reveals that a financial advisor in Ontario, Canada, is working with a client who wishes to invest exclusively in companies that do not engage in fossil fuel extraction or production. Considering the advisor's obligations under Ontario securities law and EROC rules, which of the following approaches best balances the client's ethical preferences with their fiduciary duty to act in the client's best financial interest? Option A. Conduct thorough research to identify investment products and strategies available in Ontario that specifically exclude fossil fuel companies, while ensuring these investments align with the client's financial objectives and risk tolerance. Option B. Suggest investments that are marketed as green or sustainable without independently verifying their specific exclusion of fossil fuel companies, relying on the fund provider's claims. Option C. Advise the client that ethical considerations are secondary to maximizing financial returns, and proceed with recommending investments based solely on historical performance and risk metrics. Option D. Recommend a broad range of investment funds without specific ethical screening, assuming that the client's ethical preferences will be implicitly met by diversified market exposure. The correct answer is A. Conduct thorough research to identify investment products and strategies available in Ontario that specifically exclude fossil fuel companies, while ensuring these investments align with the client's financial objectives and risk tolerance. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, is tasked with advising a client on investment strategies. The client, a long-term resident of Ontario, has expressed a desire for investments that align with their personal ethical values, specifically avoiding companies involved in fossil fuels. This situation is professionally challenging because it requires the advisor to balance the client's ethical preferences with their fiduciary duty to act in the client's best interest, which includes seeking suitable investment opportunities that meet their financial objectives and risk tolerance. Navigating this requires a deep understanding of both client needs and regulatory obligations. The best professional approach involves a thorough understanding of the client's ethical screening criteria, and then identifying investment products and strategies available within the Ontario regulatory landscape that meet these criteria while also being financially suitable. This includes researching exchange-traded funds, ETF, mutual funds, or individual securities that explicitly exclude fossil fuel companies and align with the client's risk profile and return expectations. This approach is correct because it directly addresses the client's stated preferences and financial goals, fulfilling the advisor's duty of care and suitability obligations under Ontario securities law and the Investment Industry Regulatory Organization of Canada, EROC, rules. It prioritizes client-centric advice and demonstrates a commitment to ethical investing principles. An incorrect approach would be to dismiss the client's ethical concerns as secondary to purely financial returns. This fails to acknowledge the growing importance of environmental, social, and governance factors in investment decisions, and may violate the advisor's duty to understand the client's complete investment profile, including their values. Another incorrect approach would be to recommend investments that claim to be ethical but have not been thoroughly vetted for their actual exclusion of fossil fuel companies, potentially leading to misrepresentation and a breach of trust. Furthermore, recommending investments that do not align with the client's risk tolerance or financial objectives, even if they meet the ethical criteria, would also be professionally unacceptable, as it prioritizes one aspect of the client's needs over others without proper justification. Professionals should employ a structured decision-making process that begins with comprehensive client discovery, encompassing not only financial goals and risk tolerance, but also personal values and ethical considerations. This should be followed by diligent research into available investment options, ensuring compliance with all relevant regulations and suitability standards. Transparency with the client regarding the limitations and potential trade-offs of ethically screened investments is also crucial. Question 14. The control framework reveals that a financial advisor in Ontario, Canada, has a client who wishes to invest in a highly speculative, non-discretionary security that is not on the firm's approved product list. The advisor has conducted a preliminary review and believes the product carries significant risk that may not align with the client's stated risk tolerance, although the client is insistent. Considering the regulatory environment in Ontario and the oversight responsibilities of IIROC, which of the following approaches best represents professional conduct? Option A. Advise the client that the product is not on the firm's list and therefore cannot be purchased through the firm, without further discussion or exploration of alternatives. Option B. Proceed with the investment as requested by the client, assuming the client's insistence overrides the advisor's concerns about suitability and the firm's product list. Option C. Conduct a comprehensive suitability assessment for the specific product. Clearly document all discussions regarding the risks and the client's insistence, and follow the firm's established procedure for seeking approval for non-standard products, explaining to the client that the investment can only proceed if approved and deemed suitable. Option D. Suggest the client open an account at another brokerage firm where the product might be available, allowing the client to make the investment independently. The correct answer is C. Conduct a comprehensive suitability assessment for the specific product, clearly document all discussions regarding the risks and the client's insistence, and follow the firm's established procedure for seeking approval for non-standard products, explaining to the client that the investment can only proceed if approved and deemed suitable. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, is presented with a client's desire to invest in a high-risk, speculative product that falls outside the firm's approved product list. This situation is professionally challenging because it pits the advisor's duty to act in the client's best interest and to comply with regulatory requirements against the client's expressed wishes and the firm's internal policies. The advisor must navigate the potential for significant client losses, reputational damage to the firm, and personal regulatory sanctions if not handled correctly. Careful judgment is required to balance client autonomy with regulatory obligations and ethical responsibilities. The best professional practice involves a thorough assessment of the client's suitability for the proposed investment, a clear explanation of the risks involved, and adherence to the firm's internal policies and procedures, including seeking appropriate approvals for non-standard products. This approach is correct because it aligns with the fundamental principles of client-centric advice mandated by the Ontario Securities Commission (OSC) and the Investment Industry Regulatory Organization of Canada (IIROC). Specifically, advisors have a duty to ensure that any investment recommended or facilitated is suitable for the client, considering their investment objectives, risk tolerance, financial situation, and knowledge and experience. Furthermore, firms are required to have robust internal controls and product approval processes to manage risk and protect investors. By documenting the suitability assessment, risk disclosure, and any necessary internal approvals, the advisor demonstrates compliance with these regulatory mandates and ethical standards. An approach that involves proceeding with the investment without a comprehensive suitability assessment and without adhering to the firm's internal product approval process is professionally unacceptable. This failure constitutes a breach of the advisor's duty of care and suitability obligations under OSC Rule 31-505 and IIROC dealer member rules. It exposes the client to potentially unsuitable risks and the advisor and firm to regulatory penalties. Another professionally unacceptable approach is to outright refuse the client's request without exploring alternatives or providing a clear, reasoned explanation. While the firm's product list exists for a reason, a complete dismissal without understanding the client's motivations or offering suitable alternatives can damage the client relationship and may not fully address the client's underlying investment goals. This can be seen as failing to act with integrity and in the client's best interest. Finally, an approach that involves circumventing the firm's internal approval process by suggesting the client open a separate account at another institution to make the investment is also professionally unacceptable. This action undermines the firm's control framework, potentially violates IIROC rules regarding supervision and oversight, and could be interpreted as facilitating a transaction that the firm deems inappropriate, thereby failing in the duty to supervise and protect the client. Professionals should employ a decision-making framework that prioritizes client best interest and regulatory compliance. This involves 1. Understanding the client's request and underlying motivations. 2. Conducting a thorough suitability assessment for the proposed investment, even if it's outside the firm's standard offerings. 3. Clearly communicating the risks and benefits to the client, ensuring they understand the implications. 4. Adhering strictly to the firm's internal policies and procedures, including seeking necessary approvals for non-standard products. 5. Documenting all communications, assessments, and decisions meticulously. If the investment remains unsuitable or unapproved after these steps, the advisor should explore alternative, suitable investments that align with the client's objectives and the firm's approved product list. Question 15. The control framework reveals that a financial advisor in Ontario, Canada, has a client who is very keen on investing in a highly speculative new cryptocurrency product that is not on the firm's approved list. The client insists they understand the risks and want to proceed immediately. What is the most appropriate course of action for the advisor to take? Option A. Immediately decline the investment and inform the client that the firm does not offer such products, without further explanation or exploration of alternatives. Option B. Proceed with the investment as requested by the client, given their insistence and stated understanding of the risks, to maintain a good client relationship. Option C. Conduct a detailed suitability assessment for the client regarding this specific product. Research the product's regulatory status and risks thoroughly, and if it aligns with the client's profile and firm policy permits, proceed with appropriate disclosures. Otherwise, explain why it's not suitable and offer alternatives. Option D. Investigate the product independently, and if it appears profitable, recommend it to the client, assuming the client's desire to invest overrides firm policy. Correct answer is C. Conduct a detailed suitability assessment for the client regarding this specific product. Research the product's regulatory status and risks thoroughly, and if it aligns with the client's profile and firm policy permits, proceed with appropriate disclosures. Otherwise, explain why it's not suitable and offer alternatives. Explanation. The control framework reveals a scenario where a financial advisor in Ontario, Canada, is presented with a client's desire to invest in a high-risk, speculative product that is not typically offered by their firm. This situation is professionally challenging because it pits the advisor's duty to act in the client's best interest and to understand their client's risk tolerance against the firm's internal policies and the potential for significant client losses. The advisor must navigate the complexities of regulatory requirements, firm procedures, and ethical obligations to ensure the client's financial well-being is prioritized. The best professional practice involves a thorough due diligence process that prioritizes client suitability and regulatory compliance. This approach requires the advisor to first conduct a comprehensive assessment of the client's financial situation, investment objectives, and risk tolerance, ensuring it aligns with the proposed investment. Simultaneously, the advisor must rigorously investigate the product itself, understanding its risks, potential return, and regulatory status within Ontario. If the product is deemed unsuitable, or if the firm's policies prohibit its offering, the advisor must clearly communicate these findings to the client, explaining the rationale and offering alternative suitable investment options that meet the client's needs and risk profile, all while adhering to the Ontario Securities Commission (OSC) regulations regarding suitability and Know Your Client (KIC) principles. An incorrect approach would be to proceed with the investment without adequately assessing the client's suitability, potentially leading to a breach of the advisor's fiduciary duty and OSC regulations. This could involve overlooking the client's stated risk aversion or financial capacity, thereby exposing them to undue risk. Another incorrect approach is to solely rely on the client's insistence on the investment without independent verification of its appropriateness or the firm's internal compliance checks. This bypasses crucial risk management protocols and could result in regulatory sanctions and reputational damage. Furthermore, failing to disclose the inherent risks and complexities of the speculative product to the client, or misrepresenting its potential, constitutes a serious ethical and regulatory violation under Ontario securities law. Professional decision-making in such situations requires a structured approach. First, understand the client's needs and risk profile. Second, thoroughly research the proposed investment and its regulatory standing. Third, assess the alignment between the client and the investment, considering firm policies. And fourth, communicate findings transparently and offer suitable alternatives if the initial proposal is not viable. Question 16. System analysis indicates a client in Ontario, Canada, has requested their investment advisor to engage in a trading strategy that, upon initial review, appears to involve artificially inflating the price of a thinly traded stock before a significant personal sale. What is the most appropriate course of action for the advisor, considering the regulatory environment of Ontario? Option A. Proceed with the trading strategy as requested by the client, assuming the client understands the risks involved. Option B. Inform the client that while the strategy might be questionable, it's ultimately their decision and the advisor will execute it if they insist. Option C. Clearly explain to the client that the proposed trading strategy is not permissible under Ontario securities regulations, specifically citing rules against market manipulation, and refuse to implement it. Option D. Advise the client on how to structure the trades to make them appear less conspicuous, while still aiming to achieve the price inflation. The correct answer is C. Clearly explain to the client that the proposed trading strategy is not permissible under Ontario securities regulations, specifically citing rules against market manipulation, and refuse to implement it. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the potential for those wishes to lead to regulatory noncompliance or unethical conduct. The advisor must navigate this delicate situation by prioritizing regulatory adherence and professional integrity while still attempting to meet the client's underlying objectives, if possible and permissible. The pressure to satisfy a client's demands, especially when they are insistent, can create a temptation to overlook or downplay regulatory concerns, making careful judgment and a robust decision-making framework essential. Correct approach analysis. The best professional practice involves clearly and unequivocally informing the client that their requested action is not permissible under the relevant regulations of Ontario, Canada. This approach prioritizes regulatory compliance and ethical conduct. The advisor must explain the specific provisions of Ontario securities law or other applicable provincial regulations that prohibit the proposed action, such as rules against market manipulation or misleading statements. By directly addressing the regulatory barrier, the advisor upholds their professional duty to act with integrity and in accordance with the law, thereby protecting both the client and themselves from potential penalties. This also sets a clear boundary for future interactions. Incorrect approaches analysis. One incorrect approach involves agreeing to the client's request without fully understanding or disclosing the regulatory implications. This failure to identify and communicate regulatory barriers is a direct violation of professional conduct standards and potentially Ontario securities legislation, which mandates adherence to all applicable laws. It exposes the client to significant legal and financial risks, and the advisor to disciplinary action. Another incorrect approach is to attempt to subtly circumvent the regulations without explicit disclosure to the client. This is ethically unsound and highly risky, as it can be construed as facilitating or engaging in prohibited conduct. It demonstrates a lack of transparency and a willingness to compromise professional integrity for the sake of client appeasement, which is unacceptable under Ontario's regulatory framework. A further incorrect approach is to dismiss the client's request outright without providing any explanation or alternative. While the request may be impermissible, a professional advisor should strive to educate the client about the reasons for refusal and, where appropriate, explore alternative compliance strategies that might achieve a similar, legitimate objective. Simply refusing without explanation can damage the client relationship and fail to address the client's underlying needs in a constructive manner. Professional reasoning. Professionals should employ a decision-making framework that begins with a thorough understanding of the client's request and its potential implications. This involves actively identifying any potential conflicts with regulatory requirements specific to Ontario. If a conflict is identified, the next step is to clearly communicate the regulatory prohibition to the client, citing the relevant laws or rules. The professional should then explore whether there are any compliant alternatives that can address the client's legitimate goals. Throughout this process, maintaining transparency, honesty, and a commitment to regulatory adherence are paramount. If the client insists on proceeding with a non-compliant action, the professional must be prepared to disengage from the engagement to avoid participating in or facilitating any regulatory breaches. Question 17. Process analysis reveals that a financial advisor in Ontario, Canada, is working with an elderly client who has recently expressed a strong desire to liquidate a significant portion of their diversified investment portfolio to invest in a single, high-risk cryptocurrency recommended by a new acquaintance. The advisor has observed some minor forgetfulness in recent meetings, but the client appears otherwise lucid and insistent on the transaction. What is the most prudent course of action for the advisor to take? Option A. Engage in a detailed discussion with the client to understand their motivations and the source of their information. Discreetly assess their cognitive capacity and understanding of the proposed transaction, and document all observations and discussions, considering further consultation with appropriate parties if concerns persist and with client consent. Option B. Contact the client's adult children immediately to inform them of the client's intentions and seek their intervention, without first discussing this with the client. Option C. Refuse to execute the transaction outright, citing concerns about the client's age and the high-risk nature of the investment, and advise them to seek advice elsewhere. Option D. Immediately proceed with the client's requested liquidation and investment, as the client is insistent and appears lucid, respecting their stated wishes without further questioning. The correct answer is A. Engage in a detailed discussion with the client to understand their motivations and the source of their information. Discreetly assess their cognitive capacity and understanding of the proposed transaction, and document all observations and discussions, considering further consultation with appropriate parties if concerns persist and with client consent. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated wishes and the potential for that client to be unduly influenced or to lack full capacity to make such decisions. The financial advisor must navigate this delicate balance, ensuring they act in the client's best interest while respecting their autonomy, all within the strict regulatory framework of Ontario, Canada. The challenge lies in identifying subtle signs of undue influence or diminished capacity, without being overly intrusive or dismissive of the client's expressed desires. Correct approach analysis. The best professional practice involves a multifaceted approach that prioritizes understanding the client's motivations and capacity while adhering to regulatory obligations. This includes conducting a thorough, open-ended discussion with the client to explore the rationale behind their investment decisions, probing for the source of their information and any external pressures. Simultaneously, the advisor must discreetly assess the client's cognitive abilities and understanding of the proposed transactions, looking for any indicators of confusion, memory loss, or susceptibility to persuasion. If concerns arise, the advisor should document these observations meticulously and consider seeking further information, potentially including consultation with a trusted family member or legal representative, with the client's explicit consent. This approach aligns with the fiduciary duty of care owed to clients under Ontario securities law, which mandates acting honestly, in good faith, and with a view to the best interests of the client. It also reflects ethical guidelines that emphasize client well-being and the prevention of financial exploitation. Incorrect approaches analysis. One incorrect approach involves immediately proceeding with the client's requested transactions without further inquiry. This fails to uphold the advisor's duty of care and could lead to the client making decisions that are not in their best interest, potentially violating Ontario securities regulations that require suitability assessments and a thorough understanding of client needs and risk tolerance. Another incorrect approach is to dismiss the client's requests outright and refuse to proceed without a clear, documented, and justifiable reason based on regulatory requirements or a formal assessment of incapacity. This can be seen as paternalistic and may alienate the client, potentially leading them to seek advice from less scrupulous sources. Finally, an approach that involves unilaterally contacting family members or legal representatives without the client's consent, even with good intentions, would breach client confidentiality and privacy regulations in Ontario, such as those under the Personal Information Protection and Electronic Documents Act, PIPEDA, and provincial privacy laws. Professional reasoning. Professionals should adopt a framework that begins with active listening and open communication to understand the client's stated goals. This should be followed by a careful, non-judgmental assessment of the client's capacity and the potential for external influences. If any red flags are identified, the professional should escalate their inquiry through appropriate, consent-driven channels, documenting all steps and observations. The ultimate decision should be guided by the client's best interests, regulatory compliance, and ethical principles, prioritizing the client's well-being and financial security. Question 18. Governance review demonstrates that a financial advisory firm in Ontario, Canada, has a pattern of client complaints regarding the suitability of recommended investments that are not consistently documented or escalated. Which of the following approaches best addresses this compliance gap? Option A. Prioritize closing complaints quickly to maintain positive client relationships, even if a comprehensive investigation into the suitability of the investment is not fully completed. Option B. Implement a mandatory, documented procedure for logging all client complaints, conducting thorough investigations into suitability concerns, and escalating unresolved issues to the compliance department and senior management for review and action. Option C. Address suitability concerns informally with the client through verbal discussions, assuming that most issues are minor misunderstandings that do not require formal record keeping. Option D. Advise clients that suitability concerns are subjective and encourage them to review investment materials independently before making decisions, without formal internal logging of their feedback. The correct answer is B. Implement a mandatory, documented procedure for logging all client complaints, conducting thorough investigations into suitability concerns, and escalating unresolved issues to the compliance department and senior management for review and action. Explanation. Governance review demonstrates a need to enhance compliance procedures within a financial advisory firm operating in Ontario, Canada. The firm has identified a recurring issue where client complaints related to investment suitability are not being adequately documented or escalated. This scenario is professionally challenging because it directly impacts client trust, regulatory standing, and the firm's reputation. A failure to address suitability complaints effectively can lead to significant regulatory sanctions, financial penalties, and loss of business. Careful judgment is required to balance efficient client service with robust compliance. The best professional practice involves establishing a clear, documented process for handling all client complaints, particularly those concerning investment suitability. This process must include immediate logging of the complaint, thorough investigation, timely communication with the client, and appropriate escalation to senior management or the compliance department. This approach is correct because it directly aligns with the requirements of the Ontario Securities Commission, OSC, Rule 71-501, Client Complaint Handling, and the ethical obligations of registered firms to act in the best interests of their clients. The OSC mandates that firms have policies and procedures in place to ensure complaints are handled fairly and promptly, and that records are maintained. Documenting and escalating suitability concerns ensures that potential breaches of regulatory requirements and fiduciary duties are identified and addressed proactively, thereby protecting both the client and the firm. An approach that involves informally discussing suitability concerns with the client without formal documentation or escalation is professionally unacceptable. This fails to meet the OSC's record-keeping requirements and leaves the firm vulnerable to accusations of negligence or willful disregard for client interests. It also bypasses internal controls designed to identify systemic issues or patterns of misconduct. Another professionally unacceptable approach is to dismiss suitability concerns as minor client misunderstandings without a formal review process. This demonstrates a lack of diligence and a failure to uphold the firm's duty to ensure investments are appropriate for the client's objectives, risk tolerance, and financial situation, as mandated by regulatory principles. Finally, an approach that prioritizes resolving complaints quickly to avoid negative client feedback without a thorough investigation into the underlying suitability issue is also professionally flawed. While client satisfaction is important, it should not come at the expense of regulatory compliance and ethical conduct. This approach risks masking serious compliance failures and could lead to repeat issues or more significant problems down the line. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and client best interests. This involves 1. Understanding and adhering to all relevant provincial regulations, e.g., OSC rules. 2. Implementing robust internal policies and procedures that are regularly reviewed and updated. 3. Fostering a culture of compliance where all staff are trained on complaint handling and suitability requirements. 4. Maintaining detailed and accurate records of all client interactions and complaints. 5. Proactively seeking to identify and mitigate risks rather than reacting to issues after they arise. Question 19. Stakeholder feedback indicates that some financial advisors in Ontario are encountering situations where a client expresses a strong preference for a specific investment strategy that the advisor believes may not be in the client's best long-term financial interest, potentially due to a misunderstanding of market dynamics or risk. Considering the regulatory framework of the Ontario Securities Commission, OSC, which approach best balances client autonomy with the advisor's fiduciary responsibilities. Option A. Override the client's preference and select an investment strategy that the advisor deems superior based on their professional judgment to ensure the client's financial well-being. Option B. Engage in a detailed, documented discussion with the client to explain the potential risks and benefits of their preferred strategy. Compare it to alternative suitable options aligned with their stated goals and obtain informed consent before proceeding. Option C. Execute the client's preferred investment strategy exactly as requested, assuming the client is fully aware of the potential downsides and has the ultimate authority to direct their investments. Option D. Implement the client's preferred strategy but make minor, undocumented adjustments to the portfolio to mitigate perceived risks, believing this serves the client's best interest without causing undue alarm. The correct answer is B. Engage in a detailed, documented discussion with the client to explain the potential risks and benefits of their preferred strategy. Compare it to alternative suitable options aligned with their stated goals, and obtain informed consent before proceeding. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the advisor's fiduciary duty to act in the client's best interest, particularly when the preference may lead to suboptimal outcomes. The advisor must navigate this by prioritizing regulatory compliance and ethical obligations over client convenience or potentially misguided instruction, requiring careful judgment and clear communication. Correct approach analysis. The best professional practice involves a thorough, documented discussion with the client about the implications of their preferred investment strategy, highlighting any potential risks or deviations from their stated financial goals. This approach prioritizes the advisor's fiduciary duty under the Ontario Securities Commission OSC regulations, which mandate acting honestly, in good faith, and with a view to the best interests of the client. It also aligns with the ethical principles of client-centric advice, ensuring the client is fully informed before any decision is made. This proactive engagement and documentation are crucial for demonstrating compliance and protecting both the client and the advisor. Incorrect approach is analysis. Adhering strictly to the client's instruction without further discussion or documentation fails to meet the advisor's fiduciary obligations under OSC regulations. It bypasses the requirement to ensure the client understands the consequences of their choices and may lead to investments that are not suitable, exposing the client to undue risk and potentially violating suitability requirements. Proceeding with the client's preferred strategy while making minor, undocumented adjustments to mitigate perceived risks is ethically problematic and a regulatory failure. This approach lacks transparency and does not provide the client with informed consent. It also creates a significant risk of misrepresentation and failure to meet regulatory record-keeping requirements, as the actual investment decisions and rationale are not properly documented. Ignoring the client's preference and unilaterally selecting a different investment strategy, even if deemed superior, is also a failure. This approach undermines client autonomy and the collaborative nature of financial advice. It can lead to a breakdown in trust and a violation of the principle of client-driven decision-making, provided those decisions are informed and suitable. Professional reasoning. Professionals should employ a decision-making framework that begins with understanding the client's objectives and risk tolerance. This is followed by an assessment of regulatory requirements and ethical obligations. When a client's preference conflicts with these, the professional must engage in open, honest, and documented communication to educate the client about the implications. The ultimate decision should be a joint one, based on informed consent, with all discussions and decisions meticulously recorded to demonstrate compliance and ethical conduct. Question 20. Process analysis reveals that a client in Ontario, Canada, is considering an investment in a Canadian equity fund with an anticipated gross annual return of 10% and a projected dividend yield of 2%. The client's marginal combined federal and Ontario tax rate on investment income and capital gains is 45%. If the client holds the investment for 1 year and realizes the projected returns, what would be the approximate net after-tax return on the investment, assuming capital gains are taxed at half the rate of ordinary income? Option A. The net after-tax return would be approximately 55%. Option B. The net after-tax return would be approximately 85%. Option C. The net after-tax return would be approximately 75%. Option D. The net after-tax return would be approximately 65%. Correct answer is A. The net after-tax return would be approximately 55%. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated financial goals and the potential for significant tax liabilities arising from a proposed investment strategy. The advisor must navigate complex tax regulations in Ontario, Canada, while ensuring the client's best interests are met, balancing potential returns with the certainty of tax obligations. This requires a deep understanding of Ontario's tax laws and the ability to communicate complex financial and tax implications clearly to the client. Correct approach analysis. The best professional practice involves a thorough quantitative analysis of the tax implications of the proposed investment strategy, specifically focusing on Ontario's provincial tax rates and any relevant federal tax implications. This approach directly addresses the client's stated goal of maximizing after-tax returns by providing a clear, data-driven projection of the net proceeds. By calculating the estimated tax payable on the capital gains and any dividend income, the advisor can accurately present the true financial outcome to the client. This aligns with the fiduciary duty to act in the client's best interest and the regulatory requirement to provide advice that is suitable and based on a comprehensive understanding of the client's financial situation and the applicable tax laws in Ontario. Incorrect approaches analysis. One incorrect approach is to focus solely on the gross return of the investment without considering the tax consequences. This fails to provide the client with a realistic picture of their net financial outcome and could lead to a decision based on incomplete information, potentially resulting in unexpected and significant tax liabilities. This violates the principle of providing suitable advice and could be seen as a failure to act in the client's best interest, as it omits a critical factor in investment decision-making. Another incorrect approach is to provide a qualitative assessment of the tax implications without performing specific calculations. While acknowledging that taxes will be payable is a starting point, it lacks the precision required for informed decision-making. The client needs to understand the magnitude of the tax burden to properly evaluate the investment's attractiveness. This approach falls short of the due diligence expected of a financial advisor in Ontario, particularly when dealing with investments that are likely to generate taxable income or capital gains. A further incorrect approach is to defer the tax calculation entirely to the client's accountant without providing any preliminary estimates. While collaboration with tax professionals is important, the financial advisor has a responsibility to provide initial insights into the tax implications of their recommendations. Failing to do so means the client may not fully grasp the financial impact of the proposed strategy at the advisory stage, hindering their ability to make an informed decision. Professional reasoning. Professionals should adopt a systematic approach that begins with understanding the client's objectives. This is followed by a comprehensive analysis of the proposed strategy, including all relevant financial and tax implications specific to the client's jurisdiction, in this case, Ontario, Canada. Quantitative analysis. Where applicable, is crucial for providing concrete data. The advisor must then clearly communicate these findings to the client, highlighting both potential benefits and drawbacks, including tax liabilities. This transparent and data-driven approach ensures the client can make an informed decision that aligns with their overall financial well-being and regulatory compliance.